House and Home Mortgage Co. I am mostly tuning in to talk a little bit today about what's going on with interest rates. So, Bank of Canada again today decided that they needed to increase interest rates one more time. So, they've gone up another 0.25% today. Now, that's not a huge change, but that's the 10th interest rate change over the last year and a half of our lives. It's a lot in a pretty short amount of time. And I think if you look back to even early 2022 when these rates started increasing, nobody, even with the best, best predictions, best forecasts they could have possibly made, was expecting rates to get quite this high, quite this quickly. The last time rates were this high was 2001. It's been 22 years since prime rate was where it is at right now, which is good and bad. I mean, the bad part of it is that is really going to be a big impact for everybody that's got a variable rate mortgage or a line of credit or even a personal loan or a personal credit line. All these things are impacted by prime rate. So it's not just mortgages. This is going to make a big impact on everybody's spending and any sort of debt that we're carrying across the board. The good in that is because rates have gone up so much over such a short period of time, that's really putting a strain on all of us, on the economy. And that's the point. The end goal of all of this is to have Canada, businesses, consumers, all of us, rein in our spending, slow down inflation, rise or raise things like unemployment. It's really kind of the end of a cycle like this has to get really ugly for rates to get better. And the reality is we're getting there. Already there was a report that came out about a week ago that showed almost 2/3 of Canadian mortgage holders, so anybody in Canada that owns a home and has a mortgage, almost 2/3 of them were saying they're already having a hard time making ends meet, keeping their bills paid. That's a lot of people that are struggling right now. The reason I want to bring that up is mostly to remind people that if you are one of those people that's struggling right now, whether that's because your mortgage has gone up or maybe the interest rate on that credit line's gone through the roof over the last year, there's still a really good opportunity for us to help out. There's lots of things we can do with the existing mortgage. We can look at refinancing, changing the terms up, transferring to other lenders. There's things we can do to try and make things a little bit easier. And if none of those are options, there are still even more things we can look at doing with your existing lender, whether that's trying to help negotiate for a break in payments or maybe making some changes to things like a property tax account. There are some options there. So if you're struggling or if you know somebody that is, call me. I'm always happy to make some time. That's top priority as far as I'm concerned because everybody's going through a tough time right now and everything costs a heck of a lot more than it once did, and it's not that long ago, especially mortgages. So anybody that needs a bit of a hand or needs some advice there, definitely reach out to me. Now, one of the other things I want to touch on today is why this is happening. So bottom line is, I don't think anybody in economics, any of these economists trying to make these predictions, really understood how much excess savings Canada was sitting on. COVID savings, if we want to call it that, all that money that all of us banked from not traveling for a period of time, from having a ton of overtime and extra hours at work as we came out of COVID and everybody got right back to work and ramped up and seems to be as busy as ever. All of that contributed to many people building up an excess of savings. I just read another interesting report today that was sort of indicating that savings peaked around maybe a year ago, and that it's already been on a pretty big downward slope. I'm sure, everybody personally, we're all feeling that same way. But at a national level, the expectation is that savings is going to run out before the end of this year. It's when that savings runs out that, in my opinion, things are really going to slow down because we're not going to have the ability to keep living off savings and living off credit. Credit card arrears, people missing their payments on their cards, already going up. Credit lines are going to be next. Mortgages are always the very last ones to go, but even mortgages, there's going to come a point where people aren't going to be able to make those payments. Right now, I think a lot of people are getting by, dipping into that savings, and it's running out very quickly. So what that tells me is, when do we expect an end to all of this? Well, probably not long after the savings runs out. I think we're seeing a version of this playing out in the United States right now. South of the border, the inflation rate down significantly this month, quite a bit less than anybody was expecting it to be. Unemployment up. Job growth is the lowest it's been in the States in 2.5 years. So that tells us that just like the Bank of Canada, Federal Reserve down there are doing what they need to do. They're slowing the economy, they're getting inflation under control, they are increasing unemployment. All of those things are going to combine. I think, typical Canadian fashion with finance, we tend to follow the US. So it might very well be that the US are just sort of the leading indicator of what's going to come in Canada. And they're not even done with interest rate hikes down there. Wouldn't surprise me if we see one or two more hikes based on what we're expecting over the next few months down in the States, because they don't feel like they're quite done the job yet. And really all of this is about slowing the economy enough that the central banks can lower interest rates. That's the goal. Right now, what Bank of Canada is doing is they've put the entire economy into a really restrictive position where the economy should slow down, people should spend less money, we should be producing less goods. When that happens, well, everything falls on its face and it tends to fall apart really, really quickly. When that happens, the only real fix is to lower interest rates again to balance things out. It's not if interest rates are going to come down, it's when. Now, depends on who you ask. There's a lot of different opinions out there about that. Could be as early as the end of this year. Theoretically, still pretty possible. I wouldn't rule that out. A lot of economists are going to say it could be spring 2024. It could be into, maybe summer or late next year. But the reality is, when things start to turn and when things really do start to slow down, it's going to happen very quickly. And when it happens, it's going to mean that Bank of Canada is going to have to reverse course very quickly. Historically speaking, there's a lot of precedents to be said for whenever we've reached the peak, and again, pretty likely to think we've gotten there now. When we've reached the peak of interest rates, the Bank of Canada has historically always reversed course within the next 12 months. So we're probably not that far out from them turning the corner and dropping rates back down. And I think it's pretty realistic to think that that is definitely coming. Not if, but when. But like I said before, if anybody out there is having a bit of trouble or just wondering what the options look like with your mortgage or with things like credit cards, personal debt, that kind of stuff, I'm always happy to give some advice. So if I can help out, please reach out, let me know. Thanks very much for tuning in, everybody. Have a great rest of your week.